How's it all going? I know some of those
Thanks.
names. Good. Andrew. Yeah, I know you. Hey, Chris. Hi, Raj. Hi, 1888. Ed Davey. Now that's a name that rings a bell. Where do I know you from?
Oh, a while ago, Patrick. I've known Ed
Oh,
for
mate.
ages. Hi,
Did we
Adam.
meet? Have we
We
met?
did. Yeah, we met a while ago.
Where do we? Was it in Moorgate? I can't remember. Are
Somewhere
you
like
a
that.
buddy? You go back with Adam, don't you?
Yeah.
Got it.
Hi, Ed.
Hi, Adam.
Good to see you. Thanks for joining.
Great stuff. How are you, Andy? You all right?
Yeah, I'm fine, thank you. Yeah, how about yourself?
Stuff, yeah, yeah. Trying to get out in the sun when I can. I'm a man of leisure at the moment, but I'll be back in a week. Yeah, all good, mate. Yeah, we just getting ready. Yeah, markets are interesting, aren't they? Yeah. Excuse me. I'm just going to pop myself on mute and plug one up.
Oh, hi, everyone.
Bye. Bye then.
Oleg, how are you? Are you set to go?
Yep, everything is ready. Go.
All right, good. Thanks for your patience. Can you see my screen?
Yep.
Lovely. All right, give it. All right. Well, welcome everyone to this FX Masterclass in collaboration with Sabio Trade. And thanks everyone to joining today. It's great to have you here, and we're looking forward to a really insightful and good discussion. And the topic today is how to capitalize on the Trump tariff policy. And the main focus we'll be focusing on, be looking at today will be the narrative in terms of, how does US trade policy, tariffs, and more recently, the fiscal issues, how do these impact all the asset classes with a real look and a deep dive into the FX market? And we'll be looking in broad dollar terms, so mainly G10, and also we'll be touching on the cross currencies and just opening up those a little bit and explaining a little bit about them and the dynamics around cross currency trading. And also we'll be looking at the winners and the losers out of this trade war. And helping me to do that today is my friend and business partner, Patrick Reid. And Patrick heads up our education and mentoring team, and he comes with over 15 years experience in trading. He cut his teeth at Tower Trading, specializing in derivatives and 10-year government debt. He then found his true home trading G10 spot FX with me, actually. We worked together, and afterwards we formed the Adamis principle, but that was at a New York-based international institutional broker. And Patrick, good to see you. And thanks for joining today. Also supporting us today is our colleague, Thomas Harrison. Thomas has been with us for about a year. He's an equities and futures specialist. He has plenty of passion and curiosity for the markets, and he'll be sharing his insights on the equity markets, mainly the DAX and the US indices. And I'm Adam Gazzoli. I'm a co-founder of the Adamis Principle, and it's great to be here. And it's great to be teaming up with Sabio Trade. Oleg, thanks for your contribution, and Tamara to putting this together. It's really good to be, this is a first for us in a way. Sabio's has a trading platform, and Oleg's going to go more into those details later on, but there are a lot of challenges and plans and packages. So it's a little bit different for us. We've come from more of an institutional background, and we use institutional trading platforms. So this is a little bit new, but it's just great to be part of it. And we're great that your audience and your clients and your network can join us today. So really, as I said, the narrative today, or what we're really focusing on, is that, you know, the US dollar, the outlook for the US dollar, which has really been reshaped by the tariffs which have been imposed by Donald Trump and by President US Donald Trump since the start of his second term. There are clearly primary effects that will be negative for the US economy and the US dollar, but there is also a risk, and this is just important to note, of a longer-term erosion to the standing of the dollar as the dominant currency in the global economy. So we'll touch a little bit on that in terms of, is there an alternative to the dollar? I've got a nice slide to show you, you know, and I will touch on that later on. But really, markets have expressed that the weaker outlook for the US economy, they're expressing this view via a lower dollar and also lower equity prices and a steepening yield curve in anticipation that stagflation, so low growth, high inflation, will be the character of the expected slowdown. So from a fundamental perspective, a sell-off in the value of the dollar, which we've seen, I mean, euro has rocketed. We hit a 115 handle. We nearly broke that 116 handle. We'll show you a chart shortly. But many of these negative consequences of tariffs will be felt in the peer markets as well. So growth expectations for the Eurozone, for the UK, and the Japanese economies have all been lowered since the start of the year, and downgrades have accelerated in the last several weeks. So just on that note, I just wanted to give you a little broad summary of where we are at the moment. You can see my slide. All this has been created by one man, and there he is there. And we call it man-made chaos. And then you can see the word tariffs. There have been losers amongst all this. I've already spoken about the dollar. I've spoken about equities as well. And I've spoken a little bit on the US economy and the US consumer, who is really going to be the loser in all this, in the short run especially, because consumers are going to balk at the higher cost of imports. And those firms importing as well, they're going to invest less in their businesses. So really, we're starting to see a little downturn in activity, perhaps even into a recession, that R word, a recession. Now, on the other side, you'll see the winners. And I've just put a few up there. These are just talking points. But obviously, the yen has been a winner. We've seen a good move in the yen over the last month or so. The Swiss franc, both safe havens. Japanese investors, they are active in the US, but at the moment they're repatriating funds out of the US and back into Japan. They're bringing that money home because they're losing confidence in the US administration and the US financial system. Obviously, the euro's been a big winner. We'll have a look at that as well. The euro has, initially we had the German fiscal announcement where they're going to spend more, they're going to invest more into their defense. That was the initial driver of euro strength. I'll show you a chart shortly. That was up to close to the 109 level. But since then, it's been this concern over, or the erosion to the standing of the dollar as the dominant currency in the global economy due to the impact of this trade policy. Obviously, gold, you would have all read about that. Gold hit 3,500 this week. It's just been going up. It's been one-way traffic, mainly due to, obviously, the fiscal issues, the growth issues. It's a safe haven. And in times of trouble or uncertainty, gold benefits. There's also another reason gold's going up. It's the huge central bank demand. And that central bank demand is coming from the likes of China, India, Turkey, because they're worried about the US weaponizing the dollar, and they're diversifying away from the dollar into assets like gold. And just finally, you'll see bunds there. And Thomas has got something on the German equity market, the DAX, but bunds have been a beneficiary as well. They're the German bonds, but they've been benefiting from the flight out of the US. The German bunds have been a little bit of a safe haven, and they've benefited from all this as well. So I think just on that, I'd like to just hand over to Patrick just for the moment. And Patrick, if you could just give your thoughts, and thanks a lot for that.
Yeah, thanks, Adam. Hello, everyone. Patrick. I'm co-founder of Adamis with Adam, and welcome to today's short and pithy tariff masterclass, and with dollar and risk. So, for me, I would just say, as an ex-futures trader, I traded a lot of events. I was thrown into the Greek crisis on the Bund desk, so I kind of feel quite comfortable on events. And boy, did we have those in the last 2 months, 3 months. So as Adam said, what really kicked off to me, and this is off the back of a very lackluster euro-dollar ranging, not many big figures, keeping below that 105.30, which is a really big level for me. We really had an explosion above there, and as Adam said, and that was the German fiscal story. Now, the key thing about trading any event is recognizing what's priced in prior. You can use that with data, you can use that with geopolitics, you can use that with, a hawkish central banker becoming dovish, vice versa. And for me, the key massive opportunity, which myself, Adam, and a lot of our clients took and did really well out of, was the German fiscal story. Now, Germans don't spend money. That's the fact, right? Their fiscal position, their surplus is in the constitution. So that's when the facts changed. And what happened is it broke through some key technical levels. I think it was 105.30, 106 the figure. There's a couple of levels around there. 105.30 and 106.11 is a big fib, actually. I remember it, and it broke through. And it kind of had a first leg, and then it paused, and then it had another leg. And that was super important because it did retrace, so you could have got on that. And it's just something to bear in mind. Sometimes when you're trading an event and it's so exceptional, you need to move up your risk a bit. You need to go for it. And that's paid dividends. Really, that alone made a lot of our clients their quarter in P&L. I know it was something quite exceptional, probably won't happen in my lifetime again. So there was chances. I remember, thinking if it's too high to buy, a few of our clients were saying this, and actually it's okay if you've missed the trend. That's what I want to say as well. If you've missed the first news, that first splash of the pebble in the ripples, because you can still buy on trend, but don't buy so big, right? You can add to it, and really that's that's the key thing. Just to evaluate what's priced in, how big the gravitas of that event is, and obviously German fiscal was huge, and then you got all the tariff stuff. And I'll say it really quickly and in a nutshell. With regards to the Trump tariff, it really starts to add extra accelerant. I'm a dollar bear. I've been a dollar bear for a while, and I've been in pain. I mean, especially some parts of last year, it's been painful, but it's come good. I mean, and some. And I've been looking at US tier 2 data, which is pretty soft. Tier 1, not quite off the boil, but that's to come in my view. Then obviously we had this 2017 playbook with dollar index, which is pretty much scarily chiming with where we're at now, with Trump 1 versus Trump 2, right? And you could see that post the inauguration of Trump 1 in 2017-18 playbook. So there's that. There's a lot of technicals, there's a lot of rate differentials, and there's a load of other stuff as well. But what I would say is just on the stories, the narrative, and all of that stuff, and the tariffs, because this is what this is about. You had a little bump behind you. You had backwind with the German fiscal story. Then it just got even more and more with the tariff story. Now, the key thing to remember is, and we saw this in the very first big move, which was dollar CAD. It was a 4 big figure rally. It was over the weekend, and guess what? There was a huge backpedal. We retraced all of that and some. So really, when you're trading, or when you're trading an event, or in this particular case, tariffs, it's important to remember, if Trump's going to backpedal that early on, word to the wise, it's going to do it again, right? And guess what? Let's just go through that, because I want you to all imagine that you've thrown a big pebble into a lake. The first ripple's the biggest. We saw the same, by the way, for QE1, QE2, QE3. I think QE2 and 3, dollar actually went higher, should have gone lower, way back. So in this case, you had obviously the first ripple, which is like dollar CAD, and then obviously after that, you had things such as broad tariffs being stopped or being replaced by reciprocal tariffs, which is the dilution. So it's a backpedal. You had a revision to some of those tariffs by sector. That's a dilution, backpedal. And recently, you had Apple components. Guess where Apple computers and phones are made? China. That was excluded from the China tariffs. Reversal, backpedal, right? And then really the final kind of twist here, if you're really in any doubt whatsoever about Donald Trump backpedaling, is the Fed bashing, right? Now, my inbox and my phone has just been on fire recently, because it's like, can the president sack Jay Powell, right? The important thing is, technically, yes, if there's just cause, good cause, and the Federal Reserve Act says that, but it's got to be something like insider dealing, gross misconduct, and all the rest of it. So they're trying to pin the inflation was transitory around COVID on him. Didn't work. So basically, Donald Trump was in the process of browbeating the Fed. And I'll come to my point on the backpedal in a minute. So he would resign. Little does he know the grit and stamina of Jay Powell. He then realised subsequently that, okay, so let's say he does resign or he gets sacked or whatever. That then falls on the presidency. So, if the US economy is going to go into a recession, which I think it is, who's going to take the blame? Can't blame Jay Powell if he's not in office. So there's that. But now we're seeing a humongous another backpedal. If all of those weren't enough, diluting, saying, really softening up on China, and also, saying I'm not going to fire Jay Powell. So there's yet again a backpedal. Guess what? It's a common theme. That's how you trade it. That's one spark, one aspect of it. If you miss the initial spike, you're going to get a reversal because of the backpedaling, right? So the other thing I want to add to, and I don't want to talk too long, but it's just super important. I'll finish by this. It's the reaction function to all of the backpedals and the ripples initially. You've got to do your mapping, measure the move, the initial move, and then the reversal, right? That's what's super important. That's really when you find that edge, okay? So kicking it finally into touch is, yes, there was some relief in risk. Dollar caught a baby bid. But me, with my 15 years experience in trading FX, the reaction yesterday was very muted. Yes, dollar yen went through that 69 level, which we can talk about later, but it was, S&P got a baby bid, nothing massive. So for me, and Tom's here to talk about levels on S&P, but 55, the figure, so that's 5500, is a massive level on S&P. Things change if it breaks up, but if it stays here below, it's a matter of no news is bad news. And everyone's bearish, but no one's short. I'll finish by that. Thank you, Adam.
Thanks, Patrick, for that. And just following on in regards to the euro dollar, you can all see my chart there. And yeah, I mean, you can see the move there up towards 116. But I feel for the ECB especially, the euro is a little bit strong up there. And as well, we've got the ECB cutting interest rates, and they just cut rates another 25 basis points. So I think the euro will be a little bit restrained up at that level just for the time being. And I think we're going to trade in a 112, 116 sort of range for Q2. So just note that down. Now, what's going to make us break out of that range? Well, I would say some renewed equity weakness. And Tom's going to talk a little bit about equity shortly. He's the expert. Patrick and I are more focused on FX, but if we do see some renewed equity weakness, or if US Treasuries, especially the 10 years, if they take out that 4.50% level, it's a big level psychologically. If they take out that yield, I think we're going to, due to investor sentiment, due to a loss of confidence in the US, I think we'll probably take out that 116 level in euro dollar. And also, of course, you've got the lower growth rates lower growth rates in the US and lower global growth as well. I think then we might see some more dollar weakness. But for the next little while, we just trade the levels. I've got the chart up, 112 to 116. And I didn't mention it at the beginning, but this is being recorded, so everyone will receive a copy of the recording. We have some charts as well and a presentation, as you've seen. We can send that to you as well. And I just wanted to mention, because I didn't mention at the beginning, and I meant to say, at the Adamis principle, we offer education and mentoring services. We have various packages, and they range from, 1 month out to 1 year. And if you'd like it to find out more about those services and those packages, we'll be posting a link on the chat. Patrick will kindly do that for me. And just on that, I was going to say, as we've been talking about, the US dollar sell-off, it's incorporating wider anxieties about its role in the financial markets. And it is a little bit overstretched, especially against the euro. Because if you look at where the euro is now, and I have a chart which shows this, I'm not showing it at the moment. The 2-year interest rate differentials would imply there's a real gap between where euro is now and where it should be in regards to those interest rate differentials. And interest rate differentials are very important. We look at them all the time, but it's probably suggesting a level of around, I think last time I looked was around 107 or 108. We're currently around 113.75. So there needs to be a little bit of a gap filled there. They're generally, over the last year or 2 years, they've been correlating quite well, those differentials and the euro. And these same gaps are emerging across the yen, across the sterling, across the CAD, and across the Swiss as well. I just wanted to mention that. But again, I'll include a chart on that when we send out the presentation. And just on that, I might pass it over to Thomas, who's here to share his experience and his thoughts on the equity market.
Yeah, I'm ready when you are, Adam. Should I request a share?
Yep, please.
Okay, perfect. So afternoon, everyone. Hope we're all doing well. Can you see the screen? I'll get rid of that. Perfect.
Yeah, lovely.
So yeah, I just wanted to, I guess, obviously touch on these equities. The focus at the Adamis is currencies, but having the equity sort of side of things, just given the size of the market and how, especially as we've seen this year, when the regimes move and the VIX gets above sort of 25, 30, how it's all so interlinked. When the VIX is lower, the parts in the market can kind of move a bit more disjointed, a bit more separately. But we've seen a cracking example this year that I think is really good to talk about in this context of how when the VIX really blows out, you get shifts in correlations and the regime. So I'm just going to touch on that and how that sort of developed from the start of this year into these equity markets. Then a quick bit on where we are now, and then how this sort of regime shift could sort of develop going forward, I guess. On the right-hand side, we've got the DAX, and on the left-hand side, we've got the S&P 500. I thought these two charts were really good. They both show the same time horizon around May last year to now, so about a year. And this was the first sort of regime shift we had, I think, this year. And Pat touched on it just a bit ago. But from the start of this year, we had the news about the German spending, and we had the DAX just absolutely gun for it. The volume came in because of the sort of potential unlock of spending that was going to be coming into the markets, and we got this amazing move up into those all-time highs that we stalled out at. You then come to the S&P. The past year, the S&P had hugely outperformed the DAX. I can't remember what it was, but the S&P was up about 23% last year, whereas the DAX was, I think, around 10. Don't hold me to that, but just to give you an idea of the difference in performance. The S&P was struggling up here. I say struggling, it was just taking more time to progress and make these all-time highs in the context of the DAX. Now, that's an important point because we've then seen this big historical liquidation, really. The speed in which this move's happened is only really comparable in recent history to 1987. And you can see the DAX and where we've come back to in the DAX. We're above the 61.8, not far off the sort of balance that we broke down from, whereas the S&P is still firmly under 50%. So in the SPOOs, we are down 8.6 currently on the year, 8.6%. and the DAX, we are still managing to hold on to a 16% gain. So the reason I'm mentioning this is because some people do approach the equities as they're all correlated, because in different times they are all correlated. But this is one of the first points about the regime shift that we've seen, is that you could have benefited from being short in the US equities, like focusing on short-sided trades in the US equities, and long-sided trade in the European equities, the DAX being the best to sort of express that, just because of that initial regime shift we'd had coming into the year. So that was just a point I wanted to make there. And then to come over to the S&P, because I think there's a couple of notable things to say, because it's hard to know that a market is going through a regime shift at the time. It's very much easy to point out in hindsight. But just a couple of things that we did see earlier in the year. In this big choppy balance, we had a load of news that made us gap down on Sunday nights. Initial tariff talk. We had the DeepSeek AI thing, which was in here. But a key thing to note, and it was carrying on this mentality, I guess, the market mentality from 24, was that bad news was just getting digested so well. And that was throughout here, and even tried into sort of this period after we had the initial breakdown, which kind of caught me off guard a bit, if I'm going to be completely honest with you. This big breakdown and just the way we dropped through this 3-month balance that we'd been holding. But then you started getting the little nuances. So here we'd been reacting to bad news very well. Here we started reacting to positive news badly. So we'd have a big volume spike, but then ultimately close the days weak, these sort of news failures. And that was the first sort of shift, that there was a regime change potentially coming along. The second shift was when we then broke below the prior yearly low, which at that point when we were trading up here was here, and we were able to keep making progress. The S&P previously, if you take out big levels like we did with these levels here, you get this big reaction back up and the market would just say, nah, I'm not interested in being down there. So this was sort of the second kind of regime shift. And I'm going to take this off just quick and put it on from the highs to the lows there, because this is the sort of second big point I want to make in terms of interacting with these equity markets, the S&P primarily. Levels, when the volatility gets up and you get a VIX above 20, 25, the levels then become so important, the really higher time frame levels. And so at this point, when we've broken down into this low, they're starting to get fears about the tariff. We're getting narrative around that. You're also getting some slightly weakening data in terms of the growth side of things, and just the inability to react positively to good news. But we hold this then 2-week balance, and look where the high of that balance, when we got uber bullish here, it was like that's going to be the low in the year, uber bullish into that prior yearly low, the 38.2 retracement off this big down move. This was about a 10% down move here. So that was another thing, yeah, as I said, they're just finding confluence in your levels. It's so important. And the fib retracement, which is actually something that Patrick really turned me on to, because they use it quite well in the currency side of things. I've been deploying it a lot more this year, is incredibly helpful in terms of you seeing that there's a fib off a significant move, and then you've also got a higher time frame level to lean on as well. So we then had this 2-week big, pretty volatile balance here. And then we got the Trump tariff announcement day, where it completely blindsided the markets, I think. The context of where we pulled back to, I don't think is coincidental as well. It was a prior big breakout level. This is the election week low here. And also the mid of this kind of big double distribution we've done, this lower distribution at the start of the year into this big upper distribution here. The market needed to take a bit of a pause. And that sort of comes nicely onto the third point. In terms of just recapping the way these markets have done their thing the past sort of 3-4 months. These markets don't move in straight lines. They need time to balance out, accept, build a bit of a range, distribute, and sort of, yeah, just auction. They need time. And the ability to see that we've gone from a period of imbalance into a period of balance is so important in terms of how you interact then with the market. But another really helpful fib that I've sort of been leaning on, or was leaning on at the initial breakdown here, is this fib from the highs of that day to the lows that we put in on the Monday. And just the way that we work back up the levels. It's got a little bit messier now, but just the way that we work back up the levels. But it still reinforces the point that, and you see it again here. So this was the beginning of this week. The higher time frame levels are the levels that are really driving this. So this was the August low, and Monday this week we did that big liquidation that then held up at that low, and we did stabilize into the rest of this week. So the reason I just wanted to sort of mention that sort of stuff is because there's been a real important switch from the way the market conditioned us in 2024 to now. It's sort of a distributors market right now, until, as Patrick sort of highlighted, that 5,500 level gets taken out. We can then see how the market trades above it. But it's that mindset shift as the regime shifts and the VIX gets to different higher levels, and you start seeing correlations behaving differently. The US equities aren't aligning with the European and the Asian equities as much. You then get this new correlation of the US products, so the dollar, the equities start moving together, which in sort of general theory is a bit like what's going on there. But just the ability to shift and move as the regimes change. And that was about what I wanted to say on the way that we've done this down move. Sort of where we are now, because Patrick touched on it again a bit as well. We're now kind of the beginning of the theme with this Trump tariff situation's changed a bit. And then as a result, you're seeing the equities trade slightly differently to certain comments. And I think that's really important right now, is how not to get caught in the comments that are seemingly quite big at face value, but then the market doesn't behave as you kind of expect. And I thought yesterday was a great example. We're at the highs of the balance. You then get the White House come out saying they're looking at reducing the tariffs on China. The market tries to sort of go up with it, but then instantly is sold into it. And I think that was because of the context. We're at the highs of this balance, and the theme sort of kind of degrading a little bit, maybe the best way to put it. But that's something that I think right now is so important to keep an eye on. Obviously, higher time frame levels, but how is the theme developing? How is it reacting? How are these inputs into the market being digested? Just to help in the way that we, I guess, interact with them. That's mega important. And then going forward, just from where I've been blathering a little bit, going forward, sort of the levels that are super important for the S&P. As I said, we're now in this quite tight balance given the size of the outside day candle we're sort of holding up in. And I think this does make sense. You've got the 90-day pause, but nothing really concrete has come from that. We haven't had any agreements signed or anything like that. So the market's in wait and see mode. We are between these two sort of, I guess, higher time frame levels where you've got this other time frame participants, so the really big participants in the markets. Here, 5450 to 5500 is the potential negative impact these tariffs are going to have if they don't get the resolutions. What actually is that uncertainty? So I think that's why the market's sort of fairly pinned in around here. You've seen it has have one on that day, but that was a humongous day. Expecting that to just blow all the way up isn't sort of probable. But you've had 1, 2, 3 tests now into this zone and good responses that have led to significant pullbacks. You've also had this level, this August low, which I think is incredibly important. We've looked below it and we've failed at the moment, and we are showing through the back test that it's still got demand there. So I think those two levels are the sort of really big going forward levels. So 5100 up to 5550. Obviously a huge range, but that's just given the volatility we're currently seeing. And then just keeping an eye on how this theme evolves and how the information gets put into it. And then what is the next big bit of information that can sort of get put into this market and take us from this balance that we've been in back into an imbalanced state, either up or down. But that's all from me.
Thanks, Thomas. Thanks for that. Fantastic. I was just going to ask you, is there anything outside of tariffs that you think could impact the market? Is it banks' revenue results, or what do you think?
I think the tech earnings
Okay.
are super important. We had Tesla, was it yesterday, the day before after the close? Yeah, day before after the close. The earnings weren't brilliant. They missed on a load of metrics, but Musk then came out in the earnings call and really talked it up, and we had quite a big reversal. Like Tesla did sort of a low to high kind of 10% move. So they're starting to roll through. We've got Google today after the close. So they'll be really important going forward. Definitely worth keeping an eye on.
That's good to know.
Adam.
Oh, hi, Pat. Yeah, I was just...
Yeah, sorry, could I ask a question to Tom, really?
Of course you can.
Thanks, mate. Can I just share my screen?
Yep.
Of course, let me stop sharing.
Yeah.
Yeah, thanks to Tom. That was really great. One thing I wanted to mention is when you're... I used to trade S&P in futures, and I don't now, really. But charts are the charts, right? So what I want to say is what Tom was saying is absolutely spot on, because when you have a chart, whether it's S&P or whatever it is, you've got to zoom in and out, and you've got to use that as just one of many things you look at. So on price action alone, if you've got chop, you can attribute that. You can ask yourself a question, is that right? So yeah, it's wait and see. So Tom was saying it's wait and see. It's like in the way I'm looking at it is no news is bad news. It's the flip of the old adage, no news is good news, right? So no news is bad news. And we're really having that 55 the figure as a key level. Now, one thing I've drawn it on my chart here. The thing to do is to get your bars up like this and just kind of take a pause, slow everything down. Forget your macro, your politics, forget Trump, just look at the chart. And sometimes the simplicity of the chart and price action tells you everything you need. So if you look on the bars, right, you're looking at previous attempts to crack the 55 is a big figure, 5500. We're getting to 84s, 96s, whatever, yeah, failing. So if you look on the bars, we've had 3 attempts. This is weekly. So zoom out, put it on the weekly, you get less noise. And look, we opened low, we closed high. We opened high, we closed low. We opened low, we closed high on the weekly. It tells you everything. That's going to continue until we get new news, right? So you know really what to deal with. On a weekly basis, you sell the high and buy the low. That's essentially pure tape reading, price action, whatever you want to call it, right? So that 55, the figure, is also a 50% fit from the high, around that 62, the figure, to the low, which is at 48.35. Right, so let's just quickly draw that because it's important. All right, and Tom had it in his chart as well. So if we just draw that there, we've got that level there. That's a 50% fib, right? 54.93. You see how it all comes together. So you know, by the price action, you're thinking, well, okay, I get it. This actually fits with where we're in this holding bay. We're sucking it and seeing we're wait and see. And let's not get involved when price is in between those open and closes on the bars on the weekly. Right? It's simple. But sometimes it's difficult to see the wood from the trees. And the market, remember, the market's always trying to tell you things. You've just got to listen. So I just thought I'd add that in there. And then back over to you, Adam.
Thanks, Patrick. That's fantastic. And if you'd like it, anyone on the call here today, you know, I hope that gives you a little understanding of our trading approach. We have it all documented here. If you sign up for a discovery call, with Patrick, we'll share some of that with you. Basically, our approach is, macro-driven trading ideas in G10, some emerging market currencies, but a real focus on G10. We supplement those with technical analysis. We look at those risk-adjusted spreads, like I mentioned, the 2-year differentials, and other correlations. We bring Thomas in. And with all that, we, as well as flow dynamics, market positioning, it just helps us navigate successfully during these periods of high volatility, but also periods of low market volatility. And I just wanted to mention that it's not just about the charts, or we just put it all together. And of course, we use that strict discipline in the application of trade ideas and a rigorous approach to risk management, the 80-20 model. That provides the basis for a high risk reward, high reward risk ratio, by minimizing losses on any given trade. And I just thought, since and I don't trade the VIX at all, but since Thomas mentioned that, I was just going to show you my VIX chart. Can you see that? Thumbs up, anyone? Yep. There's the VIX. Thomas mentioned it. What was the level, Thomas? Was it over 20?
We've been holding above the 25, which is quite a key psychological level for a while now.
Okay. So you get these spikes, we're settled down a little bit now. But yeah, very important to keep an eye on the VIX, on the equities. I just wanted to mention that. And just as a little bit of, I'm no expert on China, but I just wanted to try and give a little bit of an overview of China. I've been dealing with Chinese institutions. I've been fortunate enough to have worked around the world. Started my career in Sydney. I spent some time in Japan, Tokyo, trading and sales, and Singapore as well, and obviously London, where we're based now, Patrick and I. But I've had some experience with Chinese institutions, Chinese banks. I recently went to China for a few days, actually, just to have a look and get a feel of it. And I think there's all this negativity around China and coming from the US. And as the world watched, stunned, as Trump revealed his list of tariffs on that Liberation Day, China wasted little time in striking back, with its own retaliatory tariffs. And I think, in a way, they've been preparing for this moment, for a long time. Let's remember, the Chinese, they think in centuries. And this is the long-term plan. And, I think one of the things that I just wanted to mention was that these tariffs may not affect China. They may not leverage China as much as we're reading in the media. China may have more leverage in this trade war than the US, for instance. For example, they could buy soybeans from Brazil instead of the US. So these are the things. If you can do a little bit of a deep dive into the macro, don't spend a lot of time on it, but just a little bit every day. This is all I do. I'm not an economist, but let's just not forget that China's economy isn't affected hugely with these tariffs. The 600 billion worth of exports annually to the US cannot be diverted easily, and the rest of the world cannot readily absorb it. So grinding exports to the US would take off a sizable chunk of the GDP. But then the Chinese are looking at additional stimulus measures. And obviously growth is a big focus in China, growth targets. And they're not going to sit on their hands and let growth slow significantly. So, they're going to get that consumer going. That's what they're going to try and do. They're going to try and get the consumer going, get them buying. The problem is Chinese exports more and consumes less. The US are the big consumers, and that's why the US has a big deficit and China has a huge surplus. But I just wanted to mention that. It's a big topic, but it's worth exploring. It's worth doing some research into China and the yuan, and I'll just leave it there for the time being. Patrick, do you have anything else your side you'd like to mention, or have I missed anything?
No, I mean, I think it's important to factor in narrative, because that stamps all over any common sense macro. And there's a guy I really rate called Brent Donnelly. He's written a great book called Alpha Trader. There's stuff in there I already know of course, but there's stuff that is giving me a lot of fresh oxygen. So big respect to him. Ben Hunt is a really good guy as well, and they talk extensively about narrative. It's important to this is basically behavioral economics. So there's every world and his wife is a macro trader, but there's very little reference to behavioral economics and basically narrative. What is the market? What story is the market telling itself, and where in the cycle is that? Act 1, the main act 2, or act 3? And really, if you can study that, and I'm still doing this, by the way, and I'm learning every day. I'm no way near ever going to stop learning. You will be an exceptional trader, because I'm very comfortable with rates, very comfortable with macro, very comfortable with scaling risks, using cross-asset correlations, and I'm feeling this is all relative and reflected rather into my own performance, and especially in Q1. It's narrative. It's like events. It's like, what is the market trying to tell itself, and where in that cycle? So if you can do that, and look at the future narratives and see when they're starting to heat up, you're going to be an even better trader. And I'll give you one as an example. An old narrative is German fiscal. It's kind of been there, done it. But the new narrative potentially could be the execution of that money. Europe doesn't have a great history of doing that, so that could be a headwind in Eurodollar. It's just something to keep on the simmer, not quite front and center yet. Obviously, recently sell America, i.e. S&P bonds, dollar. That's the white hot narrative that's starting to cool off a tiny bit. And so really use that, and if you can, you're going to be so much better as a trader. So I'll just leave it at that.
Thanks, Patrick. That's fantastic. Thanks for that. And we're nearly coming up to our time. I wanted to just touch on two things. I was just going to wrap up. I'll wrap up in a minute in terms of what we've spoken about today, but I was just going to touch on one thing because it's a very important part of our trading portfolio, and it's the crosses. And I've just got a chart here, or a cross here, and it's Euro Yen. And if for anyone out there who doesn't know what a cross is, it's a cross current. It's an FX pair that does not include the US dollar. And there are two types of crosses. There are minor pairs and there are exotic pairs. And this is a minor pair, Euro Yen. An exotic pair would have something like the Rand in it, or the Mexican peso. But what I like about crosses is it helps me diversify my portfolio away from the dollar, especially in times of maybe high volatility in the dollar, when I don't know what's going on, or I'm uncertain with the sort of the narrative. I sometimes bring it back to a cross, and there are plenty of opportunities in crosses. We're going to look at one today. That's the euro yen. The factors that move the rest of the FX market, they move the crosses as well, such as the data. We've talked about some of it today, the central bank policy changes, political developments. But still, it goes back to the basic, knowing the narrative, risk management, correlations. And, with this euro yen one, I mean, look at it. It's been a dollar story, you can see, since the beginning of March. It's been very, very stable. But there's actually been opportunities here. It's been a nice trading pattern. It's been within a range. You could say 164, the figure, being the top, and pretty much down at 161, the figure. This is a daily chart, and it's been in quite a nice range. Sometimes we just need to stick to the levels, and there's money to be made, and there, you can produce a really nice track record. But on euro yen, basically what we're seeing very much of late, and Thomas showed you the equities chart, but euro yen is a risk, a carry trade, or a risk on trade. But recently it's defied its normal positive correlation with global equity markets. And it's been very much, we got a little bit of a lift last night, but it didn't last long. It came very much back down to earth. I just wanted to add as well, Europe and Japan, they're the biggest investor communities, and they're definitely repatriating funds at the moment, bringing them back home out of the US and into Europe and into Japan, and that's keeping the yen well bid. Another reason why I think the euro yen has been stable is that we've seen a big move in the yen, obviously as a safe haven. Their economy is very stable, and it's very predictable in Japan. And they're also going through a hiking cycle, although there is a rate announcement in May. It looks like they're going to hike, but they could push it out a little bit more, just with what's going on in terms of growth in the world and tariffs. But also, they've already tightened in a way. If you look at the dollar yen, the yen has strengthened a lot over the last 3 months, 4 months. So in a way, that's a form of tightening. So they may hold off on May. Not sure yet. Still trying to navigate that one. But just to finish up, euro dollar has already risen 12% this year, over 115. It's it's the highest level since 2021, and you can see it there. So even if those underlying economics of the Eurozone still appear relatively weak, which they are, they're weak in the activity data. We saw the PMIs yesterday. Markets are still looking for an alternative to the dollar, and the euro's a beneficiary, just like the yen. So the euro overall still looks like it's got to head higher from here, but it's probably going to be at a slower pace than what we've seen, and the gains will be more gradual. And and we expect a similar pattern of appreciation against the peer currencies to the dollar as investors seek less exposure to US assets, and risk around our outlook for currencies are high, given the sensitivity of the market conditions to Trump's actions and statements. And I'll leave it there, if that's all right, Oleg. If anyone's got any questions. If not.
Thanks, Adam.
Yeah.
That's great.
Yeah.
Yeah, just reiterating with Adam, if anyone does have any questions for Adam, myself, or Tom, just shout. Thanks, Ed.
Thanks,
That's very
Ed.
kind of you.
Yep, lovely.
Thanks, guys.
Thanks, mate.
Pleasure, Ed. Catch up soon.
Yeah.
We'll just give it a minute. All right. It looks like bit quiet on the question front, which is okay. We got off easy. Doesn't always happen like that, so we might take it today.
Yeah.
Oleg, would you like to introduce?
Sure.
Oleg's here from Sabio Trade. He's head of the academy at Sabio Trade. Like I said, it's a fantastic platform. You can purchase packages and different types of plans. And we've got a promotion at the moment, which we'll share with you, where you can purchase a plan if you decide to do so. And there's a discount of 25% by using a code, which we'll share with everyone shortly. And Oleg, over to you, mate. Thanks.
Sure. Hello, colleagues. Can you see my screen?
Lovely.
Can you hear me well? Okay.
Yeah.
So, hi everyone. My name is Oleg. I've been trading since 2012. Like so far, I'm the head of Trading Academy at Sabio Trade, and we are developing trading courses for our clients. And we provide our clients with assessment accounts to trade with our money, with money of the company. So that's why I would like to start first of all from the benefits you can get from the cooperation with our company. Please give me a second. I need to check if the connection, if the screen I'm sharing is okay, because so far I see that I'm sharing another screen. Give me please just a second. Now it should be okay. One moment, please. Let me share the first screen. The screen once again. Okay, now it should be okay. So let's start from what is Sabio. Sabio is a prop firm that provides our traders with funded account, as I already mentioned. This business works the next way. We have different traders that can purchase assessment accounts. If they pass the assessments, complying with all our risk management rules, they get funded account on which they can trade and get up to 90% of the profits that they make to the company. The rest, from 10 to 20% of their profit, company leaves to us. Actually, this is our profit, and the main idea of our company is to combine different trading techniques, to invite different mentors, traders who trade forex, trade stocks, cryptocurrencies, and unite all the techniques under one academy. So I would like to show you the Trading Academy of Sabio Trade, and by the way, this webinar also will be available there, and give you couple of ideas how you can apply all these things about the market that you've just learned, and how you can benefit from it. So first of all, you can use Sabio Trade platform that allows you to trade, as I mentioned, with funded accounts. You can like easily use it from your laptop, from your mobile phone. It's pretty similar, and allows you to trade even with small lots like 0.001 for forex pairs, which is quite conservative. Also, we have all indicators and trading other trading tools that are necessary to perform analysis. Obviously, you can use other platforms, but for like quick trading and applying all standard indicators, our platform suits really good. Also, we have an opportunity to use trading scripts. And also, I would like to tell you about our academy. That education at Sabio Trade is completely free. And we have different courses, and actually we already have a bunch of webinars with different traders that you can also watch and learn something new for you. And the main thing is that we have a pro course which consists of 10 trading strategies. We have different systems for like trading with gold, Bitcoin, Australian dollar, currencies, equities, and you can actually learn all of the strategies that we have with proven trading statistics. And moreover, we have free coaching sessions that allow you to ask questions about the strategies, consult on current market situation, and actually get any help that you need from our side. So that's why I really suggest you to take a look at the educational courses that we have, get acquainted with the tariffs that we have, because the main advantage of a prop firm is that, for example, to get an account of even $20,000, you need to have this money in your trading account. You need just to buy an assessment account for $119, and you'll get 20K assessment account. When you pass it successfully, you'll get 20K of real funds to trade. So you can easily multiply your trading amount even without using leverage and without risking with your own money. Okay, colleagues, that's maybe there are some questions you would like to ask.
I had a question.
Yep, please.
Thanks, Olive. And do you provide any, Patrick, thanks. Do you provide any trading strategies alongside your, I think you mentioned that you develop some strategies. Do you provide those strategies, and can we sort of see it, or do you have a function you can show us?
Sure, no problem. I'll share the strategies that we have. We have them here. Can you see my screen? Yeah, with the website and the list of the strategies. So we have different strategies for different assets. Let me show you a couple of simple strategies. Let's say this one, which is called Bitcoin Correction Catcher. This strategy allows you to trade Bitcoin using very simple techniques. Actually, we are looking for a case when the price drops for let's say like 0.5% of its value on a 4-hour time frame, and then we put a stop loss and take profit. Take profit equals to 100% of the candle body size. Stop loss is 150% of the candle body size. Then we also have additional risk management rules that I will not pay much attention to it. But what I want to tell you that all the strategies have been back tested. Some of them were tested manually, some of them using the strategy tester for like 3 years, 5 years, in some cases even up to 16 years. We actually tested with all available quotes that were available in this strategy tester, and before providing like this strategy, we ensured that it's really profitable. And all the strategies, they have proven trading results, though some of them are actually automated strategies. We adapted them for manual trading because one of the things that we have for, like here at Sabio Trade, that all trades should be made manually, because we value like the, let's say, original strategies, independent trading without like copy trading, and using some additional tools for automated trading. So the structure of like each video, each strategy is very simple. We have a theory that comes like in the first part of the video, then we show the backtest, and then we go to the practice and show how to apply the strategy at Sabio Trade platform. Also, we have trading channels in Telegram, where we give trading signals. We update it every day. We record the trades we make. Actually, we do everything to show you how to trade live.
Okay. Fantastic. And that's great. Thanks for that. Do you want to show, and what the packages, what do they cost? And
thank you for your question. Sure. The packages, we have actually two kind of scenarios that you can follow. The first is to buy a single account. You can see them on your screen. This option allows you to buy one account with the mentioned amount here. For example, for $111, you can buy an account for 20K. And the biggest one is the 650K account, which costs almost $3,000. This is the first opportunity you can use. The second is to buy a couple of accounts in frames of our Pro package. So the first Pro package consists of 3 strategies, and actually it goes with a discount of around 30% if you compare it to the regular 20K account 20K account package. But here you can have 3 accounts of 20K for $260 plus. The main benefit of this pro course that you'll have an access to all the videos and courses we have in our academy for 90 days. And the last account is the last package is pro package for 12 account. It gives you 12 accounts of 20K, and it costs $830, which actually means that you are buying accounts with a discount of around 40%. If somebody asks, why do you need to buy 2, 3, 5 or more accounts, it's like really simple, because the risk management in a prop firm is different from the risk management you usually have when you trade with your own funds. So we have a daily loss threshold. We also have maximum drawdown limits that actually make you trade very, very carefully. And when you apply different trading strategies on one account, you may actually increase the risks and breach the rules. So that's why it's better when you have several accounts for several strategies that are physically separated and they don't share the same drawdown if you get into it on one of your strategies.
fantastic. Thanks. Thanks, Oleg. Is there anything else you'd like to talk about or show?
I think from my side, that's all. We can like continue with your part. Maybe if our traders have some questions and they would like to ask me, I'm glad to answer them.
Do you have any your side? Do you have any of your traders have a question? Or
so far, no. Everybody is silent.
Or maybe I'll just check here to see if yeah, I'm just checking here actually. One thing I can quickly do, just because we're talking about your wonderful packages and the you know, the challenges. I was just going to share this here, just if I can do that quickly. There you go. Oh, actually, it's the wrong one. Sorry. Start again. Just bear with me.
Yep.
Yeah, just coming now. I was just going to share the banner with the promotion code to everyone. I've just got it here. Yeah, there we go. And there you go. Sorry about that. Yep. Any buttons to click? There you go. Now I've just got there is a slight adjustment to this, but you can actually purchase. This was a previous promotion, but if you use the code Adamis PR when you're purchasing a plan, I was just saying, I'm just going to update it for you. There's a new challenge, and it's valid until the end of April. We'll be sending this out on LinkedIn, and I just didn't get a chance to update the slide. But yeah, if you buy any tariff plan using the promo code Adamis PR, you'll get 25% off now, plus 30% off on your next purchase. So I just wanted to mention that. Luke, who helps us with all this, is away today, so we couldn't update the slide, but we'll send that out afterwards to everyone. I just wanted to mention that, Oleg.
Okay.
All right. Do you enjoy that, Andrew? I can see there.
Yes, yeah. I'm right at the beginning of my learning those, so there will be some questions, but they're so basic at this point in time that I'll leave them till I finish the training material.
Have a look at the presentation and the video, and please get in touch, and we can just have a discussion via the link. It's no obligation, of course.
Thank you.
And we can even guide you into we generally, with our mentees, we suggest obviously demo trading straight away, initially, and obviously challenges as well. And we're recommending Sabio trade. So it's a new partnership. A couple of our existing mentees are just signing up now. They used a competitor platform before, but we're in partnership with Sabio at the moment, and it's fantastic. Okay. So yeah,
I've already signed up with Adamis, so I guess I'll be moving on to that platform at some point. Yeah.
Well done, Andrew. Okay. All right. Well, it's about 3:20. What do you think, Oleg? Do we give everyone an early mark, or?
I think yeah. If we don't have any questions, and our traders already know what to do. Yeah, they now know also where to do. Yeah, where they can apply their knowledge and actually get benefits from trading with a prop firm. So I think it will be a good option. Because I remember when I started trading in 2012, actually we were really happy that we have this leverage. You see that we can use additional money borrowed from a broker to open trading positions. But at that time, the opportunity to boost your capital was only to bring more money or to find a person who will invest in you. But now we have this opportunity for retail traders, so you don't need to look for an option to get a job in a hedge fund. You just buy an investment, you pass it, and you get the money into management and get extra profits with no extra risks.
Well, I like the sound of that, and I wish I knew about that a few years ago. It would have saved me a bit of money.
You still have a chance to try, you see.
Well, I was just going to say, I think I'll be signing up because I've never done a challenge.
Okay.
And yeah, so there you go, everyone. I'm going to sign up myself. And
Okay.
no, I think I think we can wrap it up now. It's been a very good session. Thanks everyone for participating. Hopefully we'll be doing another one in the not too distant future. I've put my LinkedIn profile on the chat. I'll be posting things about the Adamis, about Sabio, and you can connect with me via LinkedIn, and Patrick Reid as well. That's no problem at all. And I think on that note, what do you think, Oleg? Will we call it wrap it up? And
Yep, we can.
I just had one point.
Okay.
Something I always bear in mind when I'm trading. The market is bigger. The market is bigger than myself. Yeah. And I just remember that every day because, and it doesn't have any feeling and it doesn't care about me. So it's just a good reminder when you're trading. Just try and stay humble. And we don't have, someone once said to me once, it's not about knowing everything or being right even. It's about making money and conserving your capital. So yeah, just a couple of little pointers that I think of now and then. And that's it, Oleg, from my side. And Thomas. Thanks, Thomas.
Thank you. Thank you
Guys,
Thank you.
for
Thank you,
this
everyone.
webinar.
Great.
Thanks. Bye.
Yeah. Bye.
Cheers, everyone.
Cheers.
Good
Yeah.
stuff. I think